So this is going to be the review for the midterm. There's going to be 40 questions on the test, like it says. There are going to be multiple choice. I'm going to go through and talk about the content to kind of reinforce the important bits, because those are going to be the bits that are going to show up on the actual test. So we'll just jump right in. I'll discuss each question. I'm obviously not going to read the questions, but I'll give you an idea of what the topic is. So, for example, when we're talking about insurance, there's different ways to on auto insurance and also home insurance too. Anyway, anytime there's a deductible involved, that means that's the amount that you have to pay before the insurance company starts paying. So if you want to lower your insurance rates and you can handle a $1,000 bill just popping up, then yeah, maybe you want to do that. But anyway, or you can go with quite a low deductible. So it pays to shop around and figure out what the difference is. If you're going to go with $1,000 deductible or a high deductible, make sure that you're getting a benefit out of it. That the rate's not nearly the same. But if it's quite a bit cheaper, it's probably a good idea. I mean, if you have a $1,000 deductible, you're not going to be reporting trivial stuff and using a lot of their time. You're probably going to have fewer claims, because the truth is, when you start reporting stuff anyway, insurance is rotten that way, that the minute you use it, they up your rates or cancel it if you're really abusing it. Not abusing it, but doing lots of claims. Okay. When we're talking about credit for liquidity, liquidity is a topic that's going to come up over and over in this course, and also this cold's not going away, so we're just going to power through it. Anyway, liquidity is access to cash. How quickly something can be turned into cash. So obviously, cash is by definition the most liquid, but there's other things like money in your checking account, or whatever that's quite liquid. In addition to that, money on your credit card, if you can handle the situation. There is going to be a bit of a typically 10% for a cash advance, and then the interest rates are going to start regardless of when you pay it off. There is no grace period when you're taking money, when you're taking a cash advance. So it can get kind of expensive, but if you're keeping all your money invested and doing good things, or say it's, let's say you had the money in some stocks or something, and you've done quite well, but you're looking at the dates and you're going, wow, in fact, I had this discussion with myself, kind of weird. But anyway, I had these thoughts the other day because I needed to scrape together some money for a project, and I looked at my different holdings and the different stocks I had, and one, sure enough, I bought it on September 22nd of last year. So I made a little bit of money on that, and the fact that it's been over a year means I'll be taxed at 15%. If I was stupid and didn't pay attention, and sold it, say, on the 16th of September, close but no cigar, I would be in the tax rate. Well, it'd be assumed as personal income, so whatever my tax rate is, which, let's just say for notional purposes, about 30%, so twice as much. So anyway, you have to do the math and go, if I put it on a credit card, now obviously you're not going to be putting huge chunks of money on a credit card. It really starts to get expensive, but for small things to get you through, maybe. Better yet would be, who needs cash other than, drug dealers, hitmen, people like that. For most of us, if your car breaks down, you can put it on the credit card. Then there are none of those charges. There is no interest if you pay it off within the grace period, and there is no service charge on top of that. It's only so the cash advance thing. I don't know why I brought that up from the start, because it's not the best example, because getting a cash advance on your credit card it's fairly semi-desperate. Not as desperate as getting a payday loan or one of those kind of things, but it's getting close. So if you can put it on a credit card, give you a month to pay it off, give you some breathing space, allow your stuff to sort out. Typically, like if you sell some stock or something, you can't get that money like that day. It's got to settle, And things are speeding up, actually. You know, some of the stuff, it's financial institutions take advantage of people. And so they want to say, oh, it takes this long to process. No, you want to sit on the money for that long and not give it to the customer. So anyway, maybe time to find a new bank or whatever your situation is. APR. We talked about APR. It's the only valid, comparable interest rate. Annual percentage rate. So you'll know what that is. If somebody's telling you, it's just noise that they're saying, oh, well, this interest rate, that interest rate. If it doesn't have an APR after it, then it doesn't mean maybe what you think it does. There could be fees, there could be other crap, and APR will capture all that stuff. So that's why it's important. Okay, co-signing a loan, told you that's a bad idea. And so one of the answers in here is something about, the bank basically taking your assets. Oh, by God, they will. And they'll the bank, the not loan shark, but the bounty hunter kind of guy, bill collector, yeah, they're going to come to you because, from a financial perspective, you're a better person. You got probably cooler stuff. And the person who co-signed the loan who has bad credit, he, probably didn't change the oil on the vehicles. Everything he's got is probably going to be in the same situation as his financial condition. So, again, I don't mean to be callous with this stuff. A lot of times people get into the most extreme financial situations when it's medical situations or they're taking care of a family member and, whatever. Sometimes you got to suck it up, and good people get into bad financial situations, but try to, immunize. That's not a good word, but distance yourself from getting those situations. Try and have some resources so you're not living just day to day. That you have, you've been doing what I've kind of said in terms of living well within your means, and you've been able to build up some money. You really need to. People start out working and they're making, I don't know, 20, 30 grand a year. They're just getting by, and all of a sudden they make 100 grand, and all of a sudden their needs explode. No, your needs were probably what your needs were. All of a sudden people need this or need that, and if you can just separate your income, and it's back to what I was talking about, cash flow. Figure out what your cash flow needs to be, and that should stay steady, and it shouldn't be too influenced by your income. But anyway, we'll talk more about that later. Okay, all of these situations, things that might cause you to borrow money, right? And so, yeah, there's valid stuff. Like I said, medical, college, certainly. Purchasing a car that's going to get you to work. And especially in Alaska, or if you got young kids or something. But, yeah, are the kids going to be that much better served if it's a, 2025, and do they, the kids might be happier, and you might be happier with a couple years older, especially when they destroy things. I don't know. I've certainly been there. But anyway, if you're taking out loans for, if there is no emergency and you're just doing it to get by because you can't live within your means, yeah, that's a house of cards. That's going to come apart. So that's not a valid reason to be taking out money. We talked a little bit about during banking about some of the fees and stuff that you can incur and basically floats and hot checks and all that kind of stuff. Stuff will happen though, especially with debit cards or automatic bill pay that comes right out of your checking account. Sometimes you're doing a good thing. You're not keeping tens of thousands of dollars in your checking account, and that's absolutely doing nothing for you. So you're kind of max performing your checking account, so you got it down low. But when you're doing that, sometimes there's a little mistake, and all of a sudden you have an overdraft. If you have an overdraft, they charge you all kinds of fees and stuff like that. And so what you want to do is have some sort of overdraft protection if it's available. Generally it is. And typically it means that you have a credit card associated with that account. And so if you happen to overdraft the money, then it just rolls onto the credit card, and no big deal. You go, oops, I didn't see that coming, and then you pay off that credit card, and you're good to go. If you start overdrafting it can get kind of expensive because you really don't get a say on how much you're charged because, well, you screwed up. So it puts you in a bad situation. And so they'll hit you with all kinds of little fees. We talked about collateral, security, all that kind of stuff. When you're getting a loan ideally is tied to something. Something is identified. That puts the lender in a much more comfortable position, and that comfort is reflected in a much lower interest rate that they can offer you. You know, they're still going to make their money, but they don't have to boost up the interest rate based upon the fact that, hey, this guy may flake out on me, may default on this loan. So if they know, hey, if this guy doesn't pay this loan, we can just reach out and grab the collateral, the car, the house, the whatever, they're going to be able to change that loan equation where they're just trying to compensate for the financial risks of interest and the use of money, and they're not trying to cover things like people just flat not paying the loan. Comprehensive insurance. So when you have a automobile insurance, we talked a little about this. You have different types of coverage. Liability is the one that's legally required. The way life works is you can kind of do what you want. You can be irresponsible if you want, and you'll suffer the consequences. But when you start affecting other people, that's where the law kind of intervenes. So they'll make liability insurance, the harm you cause to others, they'll make that mandatory. But other coverages like collision means you get in an accident and it's your fault. Because of liability insurance that you have to have, they'll cover the other person's vehicle. But if you don't have collision, they won't fix your vehicle. Now, collision is a significant portion of the cost of automobile insurance. So if you got an older vehicle, and again, I'm not saying take irresponsible chances, but if you say, like I was telling you with that Viper, I mean, $18,000 a year on collision, that's just unreasonable. That's just stupid. I'll just be more careful and not have to fork over, what is that, $1,500 a month? That's ridiculous. So anyway, and again, this gets back to shopping around and know what you're getting into. I knew it would be super expensive. Plus I had it up on the Nürburgring and all this other stuff. And, they were going to look at that and go, wait a minute. The Nürburgring is the Nordschleife in Germany is it's amazing, but and it's considered a public road. But the insurance companies know, hey, if you're on the Nürburgring, you're pseudo racing, and we're not paying for this. So why even bother having insurance when they're probably not going to pay? Okay. I think we've talked quite a bit. I think you guys understand how credit cards work. They make the 3% that they charge to the vendor, the merchant. You spend $1,000, they don't get $1,000. They get 3% less than the $1,000. So what is that, $30? Anyway, they get $970. But they're more than happy to make some money off you. And if you can enable that by being late on your bill, if you're late on your bill, or not even late, but if you let it carry over, they'll say, oh, just make the minimum payment. Well, if you do that, all that other payment is charged at whatever, 25% or so. Gets really expensive really quick, and that's where they make the real money. And if they can get somebody who can just do that and just roll those things over and just become kind of their debt slave, man, they that's the customer they want. They're going to make bank, and you're going to sit there and whatever, eat ramen and wonder why you don't have any money. We know how financial institutions work, banks and stuff. They pay some interest, but not very much, and then a couple, 3, 4, 5% more, that's what they loan it to you for. So they make the difference between those two numbers. Here's another question on liquidity. Having quick access to funds, that is liquidity. Certain things are not liquid. Homes. Trying to sell real estate, that is, it takes a while. You got to find seller, buyer, whatever, and the whole thing goes through, and long process. People can bail at the last minute. Great thing, but not a source of liquidity. Liquidity also doesn't speak to the wisdom of actually selling. Like I say, if you're holding some stock and it's cyclical and it's, kind of a dip right then, it's liquid. You could sell that stock, but do you want to? Or do you want to kind of wait till, some news comes out or something changes? If you know the market overall is on an upward vector, which, you don't have to be that smart. It goes up about 10% per year since, the first part of 1900 or something. The charts, I'll show you some of the charts when we get in that section, but it pretty consistently goes up. And 10% is a reasonable number. So anyway, if your spending exceeds the amount of income, what do? Yeah. You can do all these patchwork things, sell stuff, work more, get a second job. Yeah. Anyway, you're going to get burned out, and you really need to figure out what happened, and it's probably likely due to a bunch of installment payments on a bunch of stuff that you probably shouldn't have bought. Credit cards, if there are errors, this is kind of cool. They will definitely work with you and get those taken care of. But their propensity to be nice and friendly and all that is depends on the time that's elapsed. So you gotta get on it fairly quickly. Now they actually wanted to settle. I had a stupid parking ticket I got down in Anchorage, and I got the meter maid or whatever the most derogatory term for those people are. I know meter maid's probably offensive to them, but whatever. They hit me for a $20 ticket, and they had to be sitting there with a stopwatch waiting for that meter to click over. So I went back after the credit card company going, look, I spent $2.40 on my thing, and I want to see the actual timestamp. I want to know when I was given the ticket and put the burden on them. Their administrative fee is certainly going to burn up more than $20, so there's that. Anyway, there's some kind of math problems. Here's the lady bought some stock, bought it for this price, sold it for that price, and how much did she gain, and then was it long or short term gain? So semi-easy math, very easy math. And then was it greater than a year? Was it less than a year? Less than a year short, greater than a year long. So quite easy. Concept that money received today is worth more than money in the future. Yeah, that's because you can put that money to work. Now again, this can go horribly wrong if you put it in super risky stuff. But if you put it in something that's earning compound interest, that's huge. And so you're earning interest on interest. So, you look at some of those problems where somebody, wins the lottery or something, and should they take this much now, and it'll be a lesser amount, or they'll say, or we'll give you, twice that 20 years from now. It's not as easy as just saying, I want twice as much. No, you have to look at, if you invest that money, what will it grow to? Fixed rate mortgages. The beauty of those is if you have a mortgage, again, this is pre-boomer. This was my parents. They had a mortgage when I was growing up that was $133 a month for a reasonable house. I mean, it was getting to the end of a 30-year mortgage. So, I mean, stuff used to be fairly cheap. But the point is that, this was some years ago, but just the same, 133 years ago, a few years back, was still not much money. The mortgage will stay the same. Rent will be indexed to inflation. So rent will go up over time. But mortgage, if it's a 30-year fixed, or, whatever fixed, it's going to stay the same. Homeowners associations. Yeah, I mean, my solution to that is get more property. So who cares what the neighbors do? They're far enough away to where it doesn't bother you. But if you're not in that sort of environment, if you're not in a place that has, you know, large lots like that, they can do certain things to improve, you know, in terms of controlling, you know, just how much of an eyesore your neighbor's home can be and all the rest of that. Or they can just be a place where, you know, a bunch of folks hang out and gossip and try and whatever. It can get quite ugly, and they're sometimes quite expensive because they'll vote for some assessment and you're on the hook for it. Opportunity cost. We talked about opportunity cost way back in like the first week. And again, when somebody says, oh, I don't have any money, I can't save anything right now. Well, you know, life is choices. And if you choose to do one thing, it precludes you from doing the other. And so if you spend a ton of money on one particular item, you're not going to have the money for the other item. So best way to do this, you know, in terms of saving is to allocate the money early in the month, and then your chance, your propensity to spend all that excess money is gone because it's already allocated. And then the rest of the money you got, you can spend it guilt-free. Or you can do something stupid with, not stupid, but, you know, more risky with it, you know. I'm a big fan of crypto, but you do not invest money you can't afford to lose. And so, you know, you've got your basic investments covered, you know, something reasonable, and then you take a flyer. Now, I don't know. I'm becoming more of a Bitcoin purist. Maybe Solana and Sui and stuff. But some of these junk coins to you know, get 100 to 1, man, I've been there, done that. I do not do that anymore. Thankfully, I never used big money in it, but the point was, you know, you really didn't need big money when you're doing 100 to 1. But if I would have put that money in plain old Bitcoin, it would have been way better. Okay. This question may change over time because it's talking about something on buying something on credit will affect your tax bill. And the correct answer would be the only item that you can buy that would affect your tax bill in terms of credit would be a home, because that mortgage interest is tax deductible. Credit card interest used to be tax deductible, and again, the IRS, you know, they're kind of under the impression that all the money is theirs, and so they got rid of that deduction on regular credit cards and stuff. That happened a long time ago. Anyway, the current administration is talking about bringing it back for automobiles that are manufactured in the U.S., so that'd be kind of cool. Again, tax deductibility is not a tax credit, but I think we talked about that beforehand. When should you start retirement planning? As soon as possible. So that gets back to the whole thing about, you know, compound interest and stuff. Even though you go, well, I can't really put much money away right now. You'll be surprised how quickly it grows, especially when you have compound interest and time working for you. What else? Health insurance, we haven't talked much about that yet, but the big deal with health insurance is it's super, super expensive. You know, I mentioned it early in one of the lectures, but the reason why it is more affordable for most people is because the employer, you know, they have a pool and they typically subsidize part of your health insurance. So that is one of the key perks, you know, when you're looking at working for somebody. Unfortunately, you know, employers have kind of stripped down all the perks because they're expensive. And so if they're trying to hire somebody and they say, oh, we'll pay you, you know, $80,000 with full benefits, you know, go, yeah, that's cool. But this other company is paying $100,000 and they offer no benefits. most people are greedy and go, oh, I'll take the 100 grand, not realizing that that 80 grand plus benefits is probably worth more. But anyway, you got to look at the situation yourself. But, when we talk about bankruptcy and other things, like I've said, health insurance is what, leads people a lot of times. The other problem with health insurance, too, is sometimes they kind of own you. You got a crummy job, you don't want to be there anymore, but you can't quit because you got good health insurance. So you're sacrificing a lot of your liberty by not having a little bit of money set aside. If you had a little bit of money set aside, say, yeah, I'm going to have to get private insurance, or there's going to be a transition until I get the new job, but I've got a little chunk of money set aside and I can weather this until. So, it keeps you from being job locked. So it's just peace of mind if you can just suck it up and get some money stored up. Stopping payment on a check, not often used, especially now since things are processed electronically. But if a check hasn't been processed, then yeah, you can certainly do it. So if it's already cleared, it's water under the bridge. But if it's a lost check, obviously it's not going to be cleared, so you can stop it, and that way the person who wrote the check isn't under some sort of fear that say, oh, I found it, and guess what, I just cashed it. That's obviously theft, but that can all be precluded by just putting a stop payment on it. Some loans are long term and some are short. So, housing, car loans, all that stuff, those are done over long periods of time. So over a year, you're not going to buy a house and pay it off in a year. Car loans, not in a year, and student loans. So different types of debt have, different typical durations. How do you measure somebody's wealth? It's not really by what they have, net worth is the best measure. Assets minus liabilities. And, you can, whatever. Good assets are worth something. So it even gets down to the quality of the assets. Like I say, I don't mind being in debt if the interest rate is low and the assets appreciating, preferably higher than the loan rate, then I'm making money. You want to reduce your homeowner's insurance. One way to do that, increase the deductible, just like I said, right? That's one thing you can. There's a whole myriad of things. Make sure you got your ducks kind of lined up before you get in this discussion. You don't want to perjure yourself or lie outright or whatever. Make sure if you're going to put in a burglar alarm or certainly your smoke alarms, things like that. Those are all important. Even there was a lady I knew who she wanted to buy a bunch of horse equipment from me, but she was too far from the local fire department, and they wouldn't insure her. They said, nope, that's too dangerous of activity, and the distance is too far, and so they thought the exposure was too much. So, if you have a fire hydrant right in front of your home, they'll probably, those people are weird. They'll kind of get creepy with Google Earth and stuff, and they'll be looking at the stature. I've gotten calls from the insurance company and saying, hey, we noticed this is going on with the home. What's going on? Your roof is looking kind of shoddy. You're going to take care of that? And so somebody's out there with a camera creeping around in the bushes. I switched insurance companies. I now have an insurance company in Texas. I don't need that kind of attention. So anyway, interest on time, called compounding. We talked about that. We talked about adjustable rate mortgages. Interesting thing, useful sometimes, riskier, yes, but within limits. Again, the cap can kind of they can't jump your there's a maximum that can go up each year. It may be 1% or so. So a couple 3 years you could be in serious trouble. But if it's a hugely different rate, it may make sense. Not as popular now. A little tougher to qualify for. We talked about time value of money. We talked about how things are worth more in the future because of compound interest and all that. For insurance, we talked a little about this in terms of if you have items that are of extreme value. Let's say you have a bunch of jewelry, you have a bunch of photography equipment or something, and you get your standard homeowner's policy and you think, I'm good. You know, they don't know, but they insured all this stuff. They're going to have to reimburse me in case all this stuff gets ripped off, and the insurance policy is really cheap. Well, if you read the fine print in that insurance policy, it's like 20 pages long, there's category limits. And it may have something like, you know, jewelry's insured to a maximum of whatever, $2,000 in this category. And you got way more than that, so you're not going to be whatever. If you've got something valuable, go ahead and identify it and get an addendum, a personal policy floater, whatever they want to call it. It's a codicil, a modification to the contract that identifies those items, and it's pretty useful. I guess personal property floater is probably the most common terminology. If you're trying to do your taxes, obviously you want to pay the lowest amount, so you want to be in the most favorable category. If you're going to file head of household, well, number one, you got to have some dependents, right? And then also you were not in the married category, because obviously you'd stay in the married category. You wouldn't have to go through this head of household thing. So you'd be single and you would be have a dependent. Now again, only one can claim the dependent. Only one parent. Purchasing a home, who pays the commission? The seller. Credit card, pay the balance every month and you won't have to pay any interest rates. So there you go. So some of this stuff gets kind of redundant, you know, where we're talking about what type of loan generally charges the lowest rate. It's going to be the secured loan, right? Versus an unsecured. Unsecured is just a bunch of random stuff that typically can't be repossessed. I mean, they can go after your bank accounts and stuff, but it's going to get messy. A secured loan where they've got like a VIN number or something specifically identified, they're going to come after it. We talked about liquidity. We talked about cash being the best for that. More opportunity cost, so no opportunity cost. Yep. So let's say you've got student loans to be paid, but you decide, rather than pay those down, I'm going to go get a new car. So you defer paying your student loans, which is probably going to delay you paying or having the money to buy a house, or at least you have too many liabilities where you can't get a loan. So you get that loan debt, student loan debt, paid off, or get it forgiven, work for somebody who forgives it, or do what you got to do. Don't rely on a political solution. That whole thing about, we're going to forgive all student loan debt. Yeah, that comes around every 4 years, and they won't deliver on it. Both parties have had the opportunity, and I mean, it's a kind of a fairness thing. I'm not going to, but anyway, there's a lot of resistance to that, but it sounds good. It'll, it's something that gets people to come out and vote, but will they deliver on it? Nobody has yet. Not covered in homeowner's policy, flood insurance, right? What happens is the concept of insurance means that you're not expecting everybody to have a bad day on the same day. So, flood insurance is that everybody can have a bad day on the same day. And so what would happen is if you're insurance company down in Florida and you're private and you're taking out insurance policies for a whole neighborhood, and that whole neighborhood gets flooded, well, they're going to take everybody's premium for years and years, and then everybody gets flooded, and they file a claim against the insurance company. The insurance company just declares bankruptcy and leaves town. So it just doesn't work. You know, the automobile insurance, you know, there's 1 million people in a town, city, whatever, and, you know, a few hundred get in an accident every day, and the numbers are right where it can work and the insurance company can make money. But flood insurance doesn't work that way. Cash advances, yeah, they're not like regular credit card charges. There's a interest from day one, no escaping that, plus a service fee on top. We talked about using them for emergency funds, not bad. And monitoring your debt level, very important. Why do you do that? So that you don't all of a sudden realize, uh-oh, I've got a real problem. You know, I can't make ends meet, yet all these loans, I'm going to have to pay them for several years more. So not only am I screwed today, but I'm screwed for multiple years. Or, you know, you lose your job or get cut back on hours or get sick or something. I mean, it's not good. So make sure your debt level is under control to give you the peace of mind. And another thing about insurance, so what are the different strategies for insurance? You know, why do you have insurance, basically? You can avoid risk, you know, and that would, you know, preclude you from needing insurance, but you can't really avoid risk. I mean, you're going to go through life. So avoiding is probably, you know, fully avoiding is probably not possible. You do want to try to minimize it, but that's fine. You can say, guess what, I'm self-insured, like, you know, getting back to the silly Viper I had. Just say, yeah, it's really going to kind of be brutal if it happens, but I can do it. Or you can turn that risk over to somebody else so you can insure against it. You can pay a premium to a company and they'll take care of the risk. So what I haven't listed in here, and the thing that you should not do, is just pretend like it's never going to happen. Just ignoring it. Ignoring it will not work. The risk is out there, and now you're setting yourself up for failure because you haven't really considered. You haven't, you know, taken steps to avoid it. You just ignored it. You haven't made a rational choice to accept it, and you haven't insured against it. So that's about it. Those are going to be the questions on the test. You'll take it on Blackboard. You'll turn in the homework beforehand, and everything will be good. Good luck.